It's that time of the quarter where I look at the US banks and see how they're getting on. And generally speaking, across the board, their shares have done pretty well this week. I've focused on the big four here, which are JP Morgan, Bank of America, Citi, and Wells Fargo in that order. And roughly, not quite speaking, but the sort of the worse of a bank they are, the more their stock appears to be up this time. Results were kind of broadly similar, and I'll run through them quickly, but you'll see the themes kind of emerge as we go along. JP Morgan then, which leads out earnings because, well, I guess they kind of think they're more important than everybody else, and they probably are. So revenues were 43.74 billion, which was up 10%. Earnings per share were $4.81, which was up 58%. There was strong growth in investment banking revenues, which is interesting to me. That was up 49%. Trading wise, results were good, 20% up in the fixed income department, 22% up in equities. Their net interest income was down a little touch, about 3% or so, and they had their earnings boosted by 500 million of credit loss reserves that they let out rather than taking them in from the previous quarter. Bank of America. Market was less impressed by Bank of America. It's only up to nearly 3%, 2.95 this week. And it slipped back on the day of its earnings, but partly because it had already been kind of swept along by the ones from the day before. Bank of America was a day later than JP Morgan, Citi and Wells. But revenues there were up 15% in total, so slightly higher than JP Morgan. Earnings per share were up an awful lot more because of some one-off issues in the previous year. Investment banking revenue again up strong, 44%. Trading up 13% in fixed income and 6% in equities, which is quite a bit weaker than JPM. $400 million credit loss reserve coming out again, pushing profits higher, and net interest income was up for these guys, 3% or so. So broadly similar themes, flattish if you think net interest income overall. Decent trading, better from JP Morgan, and both strong on the investment banking side. Wells Fargo had net interest income down quite a bit from what I could see of it, but revenues were largely flat, which is, I guess, disappointing for a bank like this, but remembering they're still under an asset cap for the moment, making life much harder for them to do any growing. Earnings per share were up 66% to $1.43. They had 200 million coming out in credit reserves that were released. Investment banking revenue was up 28%. Trading revenue was up on the fixed income side and down on the equities side, which is a kind of weak result, but the stock climbed 9% anyway. And Citigroup, the thing that I own and was pulling its way higher to about a 12% gain on the week until it sort of stepped back a little bit, was a revenue gain of 12%, taking them to 19.6 billion. Earnings per share up 60% to $1.34. Net interest income up 9%. Investment banking revenues up 35%. Very strong trading results both sides. 37% on the fixed income. They traditionally have a pretty strong fixed income trading desk. 34% on equities, which is not bad either, looking at everyone else going around there. 204 million of credit reserve releases coming out. Steve, you're seeing similar themes that interest rates are not quite there yet on the US. They're not where they were in sort of 2020 peak investment banking season, but we are seeing investment banking coming through here and trading results looking sort of fairly strong here in stock market volatility and indeed bond market volatility as well.
There's normally a couple of banks, Steve, when you go through this and you think like, oh, that one's good, that one's good, well, that one's not so good. That one's really good, and that one's just average. But to me, looking at especially the four big lenders, they've had a pretty incredible period of time. There's essentially the four biggest lenders have had it's the second most profitable year ever since that. I think it was the 2021 IPO kind of boom year, but back over 100 billion in profit. That's obviously JP Morgan, Goldman Sachs, Wells Fargo, and Citigroup are what you would call the big four. Back over 100 billion in profit is fairly incredible. JP Morgan, the biggest of the lot, doing 50 billion in profit itself. Citigroup, like you say, Steve, 3 of its 5 main segments are doing record revenue for the year, and that's their wealth services, US personal banking and other banking services, all having a cracking time. Um, Goldman Sachs' equity traders, record revenues, corporate deal making picked up across the range. Um, Wells Fargo, which is probably the smallest sort of Wall Street presence among the big banks, annual revenue from investment banking was up over 60%. Um, Incredible, really, Steve. When you look down this list of bank performances, there wasn't really a bad one, and that does that mean we're missing something obvious? I don't know.
A couple of things. Well, three things. Two small ones. One sort of bigger, depthier one. Then they were strong across the board, and actually, one reason I was kind of alert to them being strong across the board is that the banks are an industry in general that has benefited from the election result, just in terms of share prices for the moment. Less regulation is thought to be helpful for the banks coming in. And Jamie Dimon was pro-Trump lower tax policies in terms of economic growth. He talked about more kind of global uncertainty and so on. But we haven't actually got there yet. Trump doesn't take over until Monday. So it's interesting to see things moving in the right direction, including the share price. You might have wondered how much of this was kind of already priced in, and the answer was apparently not all of it. So that was interesting to me. Wells Fargo, I think they had the worst equities performing desk of them, and I just happened to see unrelatedly yesterday on X. But do you know what Wells Fargo's share price target for Tesla is, Steve?
Um, no.
It's $125, which is down 70%. They're expecting for that from the course of this year. And if you put enough money behind that,
I'm with them.
You are with them. They are down 16% on their equities desk when Citi are putting up 34. But I saw that as an interesting kind of thing to consider there. But honestly, my attention in this is now basically on Citi, by and large. So I've owned most of these at some or other point, and in a lot of cases, it was too early for me to really meaningfully make any sense of what I was doing with them, especially Wells Fargo, where I owned that during the COVID thing and sold it flat, and it's more than doubled since then, which has been a raging disaster. But City, I'm getting onto the point of rethinking here, to be honest. Especially the more it creeps, the more I think I ought to do something about it. And so far, every decision I've had to sell a US bank has been wrong, basically, both in the short term and so far over the long term. I sort of picked this up. I got interested in Jane Fraser's turnaround plan back in 2021 when I read this somewhere as well. She was basically given the job of untangling a bunch of financial Christmas lights, and the way that she did it was by trying to cut away as many of them as she could and not bother with it. And the ones that she couldn't cut away, she's basically started sacking. So they've cut 20,000 jobs there. Sold off subsidiaries in the Philippines, Australia, Indonesia, Vietnam, Malaysia, Thailand, Taiwan, India, China, Mexico. They're working their way out of Poland, which is difficult at the moment because of the political situation over there, and out of Korea, where they're struggling to find a buyer, but they're basically winding those operations down as best they can. And since I can remember, people have been saying buy back this stock because it's very, very low on a price to book ratio. It still is, but they are finally throwing the buyback cannon at it. They gave a buyback amount of 20 billion, which over an unspecified time, but probably means a year or so. That's about 13% of the market cap getting bought back in the year, and it's getting bought back below book. One of the impressive things about all those divestitures actually is that they were nearly all sold above their book value, which, considering where City's trading, the idea that someone's buying their stuff off them above book value, I would have said shut the whole operation down and give me the cash back. But those are decent sales, I think, and it's good to see a buyback kind of eventually coming here. It makes me really reconsider where my price target for this is. It's probably slightly above, where in fact it's definitely at least slightly above where it is at the moment. How much longer I want to go with this for is a good question. I mean, Fraser might have turned this into something that has a distinctive long-term edge here. They have a strong global presence, especially at the business level, leave aside Wise for the moment. That offers something that no one else does. I think 90% of the Fortune 500 are customers because they can handle cross-border needs better than most places can. I don't see them acquiring Wise because I see them as going smaller and concentrating rather than outward and bringing them in. But it would be a nice synergy for that to happen here. This week's going to be a week of sharpening pencils for me and trying to figure out exactly what I'd be willing to let Citi go at, or at least part of my stake in that thing. And how far I can live with the idea of being wrong if it goes any further. There might be a lot of it comes down to that psychology of what can I walk away with and say I'm happy I held on, and from this point, good luck to anyone who wants it going forward.
Yeah, just something I'll just tack on the end. So the expectation from a lot of the bank executives is that when Trump comes in, his watchdogs or his team are essentially going to ease off on things like bank oversight, probably repeal some of the rules the Democrats have brought in, and drop this campaign at the moment that requires the too big to fail lenders to hold more capital to buffer themselves against economic shocks. And this was kind of echoed in what Diamond said. He said that he was hoping for more constructive discussions with the regulators, and he basically tore into the Fed's stress testing of lenders. He said that he said it produces results that they couldn't understand, and said that the authorities need to balance economic growth with bank safety. And his parting message to them was, it's about setting rules that are transparent, fair, holistic in their approaches, and are based on rigorous data analysis. So I think this is Diamond essentially saying he thinks the current stress tests are crap and they need a rethink. And he's coming to the end of his tenure at JP Morgan, so I wonder if he'll get sellotaped into some kind of watchdog to come up with a better scheme. And I would back him to be able to do that. He's a risk-averse kind of guy, but he's made JP Morgan into a monster bank, and he could probably come up with some rules that are fair and equitable for the banks.
Yeah, and probably also decent for the country, to be honest. He is a thoughtful guy. He's a Democrat. He's pretty patriotic, though. He's, I think, probably an America First Democrat, if that's not a contradiction in terms. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.